Okay, folks, we are back. Still on handout 11. We're 2.5 pages into it at the middle of the page. I'm just going to talk a little bit about some banking terms and a little bit about the banking crisis that occurred a little over 10 years ago now, and which some people still say we are living with the results of. All right, a security is any contract or evidence of ownership that can be assigned a value and traded. So, stocks, futures, mortgages, promissory notes, government bonds, corporate bonds all fall under the general heading of a security. In the early 2000s, some bright eyed folks on Wall Street got the idea of taking mortgages and creating what came to be called mortgage backed securities. What these were is they would take groups of mortgages and bundle them into parcels of 10 or 20 mortgages of anywhere between a couple of million, $10 million. And then they would take these bundled packages and sell them to investors. Now, at first, this seemed like a tremendously good idea because the history of mortgages in the United States since the Great Depression of the 1930s was that there were very few foreclosures, that the vast majority of people paid their mortgages in full, paid them on time, and the interest rates that were being paid on mortgages at that point in time in the early 2000s were upwards close to 10%. So it was an incredibly lucrative investment. And the various houses that deal in securities in New York and London created these packages of 10 and 20 and $50 million securities made up of a number of mortgages and peddled them around the planet to insurance companies, pension funds, to trusts, to all different types of folks who were looking for a way to make good interest on their investment, but also have something that would be considered secure. At the same time, the bankers began to create different products that they called securities, but that were very, very esoteric in nature and rather far out there. One of these was called a credit default swap. And what it basically is, a credit default swap is an insurance contract that you buy on a loan. So that you're basically buying an insurance contract saying that you're either betting that the person will or will not default on the loan, and depending what happens, whether they pay it off in full or they default on it, certain payments are made. One of the interesting things about this is for insurance law in the English speaking world for 500 years, you had to have something called an insurable interest to purchase insurance and to deal with insurance. So I cannot buy a fire insurance policy on your house because I don't own your house. And any attempt to do that would be considered null and void. The interesting thing about these default credit swaps was that they very quickly got regulations in place that said they did not have to be made between the owners of the underlying loans and securities that they were betting on. So in effect, it became almost a form of gambling. Right? Very often, these were used along with the mortgage-backed securities that were being sold. The agents and the brokers who were selling them would also include a default credit swap security insurance policy. So telling the buyers of the mortgage-backed securities that, oh, you're really safe because not only are these mortgages and people always pay them, but we're giving you this insurance policy. So if something goes wrong, don't worry, you have insurance. As the real estate boom picked up in the early 2000s, as the prices began to escalate, and at a certain point, if you were to look at history from 1999 through 2007 and 8, in some places of the country, the value of residential real estate went up 300% during that time. And it went up faster towards the end. Many, many people began to buy real estate not because they needed it for a home or they needed it for investment, but to speculate. Speculation is when you are buying an asset in the hopes of turning it around, selling it quickly, and making a profit on it for the period of time that you owned it. Well, speculation only works in markets where things are going up. And in the early 2000s, things were going up in the real estate business. Real estate, as I said, was selling. The values were going up very quickly. And even if you ended up buying a house that you really couldn't afford, you got into it and found out you couldn't make the mortgage payments, the value was rising 3, 4, 5% a month. If you could hang on for 5 or 6 months, you ended up selling the property and walking away from the closing with several $1,000s in your pockets, even if you had to pay the mortgage for 6 months. So, the real estate speculation boom began. Along with this came the idea that processing mortgages became a commission driven reality. When I first became an attorney in private practice 30 some years ago, every bank had a mortgage officer. Every credit union had a mortgage officer. The mortgage officer was paid a set salary. Their job was to protect the bank and to protect the depositors. If you went in to borrow money for a mortgage, they would quickly look over your paperwork, they'd look at your credit report, they'd look at your income, and if you could not afford a mortgage, or if they felt that somehow you were going to be a risk to their institution, they politely ushered you out the door, sometimes with information. Fix your credit report here, go take care of that, make sure you take out a credit card, pay it faithfully every month so your credit will look better in a year. Wait till you get that raise from your job next year. Come back when you have a little bit more income and maybe we can qualify you. Their job was to be the gatekeepers to protect the institutions. Somewhere in the late 90s, that all began to change as the banks began to get the idea that instead of paying salaries for people to do this, we will hire people who will work on commission. And of course, their commission would only be paid if the loan actually went through to being consummated, to being finalized. Well, unfortunately, when you have people whose income is depending on the transactions going through, when you have a market where the prices are always going up so that even if somebody gets in trouble with their mortgage, they can turn around and sell the property and walk away free and clear, fraud and corruption begins to creep in. It was very easy for a mortgage broker who's $2,000 or $3,000 commission, depending on the sale going through, to say to the prospective buyer, "Go tell your boss to sign a paper saying you're going to get overtime in the next 3 months, and that'll make your ratios just right. That'll get your income to the place where we near it to be." Or have your mother co-sign with you so that we know she doesn't have any money, but she does have some Social Security income and pension income, and we'll put her name on this too so that you can qualify when otherwise you wouldn't. It becomes very easy and almost justifiable, if your bread and butter depends on making sure these loans get processed, to help people in this. And then the banks also began charging fees for the processing. So there were many banks, many mortgage companies who were making far more money from the processing of mortgage loans than they were from keeping them and collecting the interest on them. So you now had people who were going out finding people to take the loans, who were paid on commission. You had lenders who were being paid enormous fees for setting up the loans. And because of this whole securitization, because of the mortgage-backed securities, the lenders could very quickly sell the loans and be rid of them. So if the loan blew up, it was no longer carried on the lender's books. It wasn't an issue for them. It was somebody else's problem. Well, into this mix began to creep all kinds of very poorly thought out mortgages, poorly researched mortgages, poorly originated mortgages, and scores, millions of people who had no right to buying a property, who in no way in normal times would qualify for getting a loan, were being given $300,000, $400,000, $500,000 loans to buy real estate. This was all good until it wasn't. And then somewhere in 2007, defaults began to enter. Prices had reached such a height that people could not possibly qualify to buy the properties. That in many of the suburban cities and towns of New England and the New York, New Jersey area, a firefighter married to a school teacher could in no way qualify to buy a piece of property in the towns where they were employed. Working class people had not a chance of buying real estate. The prices reached a point where they were no longer sustainable. One of the most dramatic things I saw was somebody had bought an old three-family, a triple-decker in Central Falls, and had rehabbed it, and they had done a beautiful job. The building looked beautiful. I drove by it several times a week on my way to and from one of my commercial clients, and it was beautiful. However, they were trying to turn the three-decker into condominiums, and they wanted to sell the condominiums for $150,000 each. That's $450,000 for a triple-decker in Central Falls. I remember when I saw the ad and read it, and I went to one of my partners and says, this will not last. This cannot happen. There are how many people in Central Falls can afford to buy a $450,000 property? How can this possibly be worth that? And of course, in the long scheme of things, it wasn't. Beginning in the summer 2007, prices began to stall. Then they began to drop. Now, the people who had bought mortgages that couldn't really afford them, now they were in trouble. They would try to sell the houses, they would try to sell the properties, but as the values began to go down, they were now upside down. They had borrowed 95% of the value of the property. If the value of the property dropped 15%, they were now in a situation where they would have to bring cash to a closing to pay off the mortgage in order to sell the property. That just snowballed, and it became an incredible mess, and investors began to freeze up the market and stop buying things because they were looking at these different securities that were tied into the mortgage business, and you couldn't tell, was I buying good mortgages, or was I buying mortgages that were going to fail, that were going to blow up, and then my investment principal would be worth nothing, never mind not getting the interest that was there. Finally, the economy reached a point in 2008 where several stock brokerage houses had gone under. It appeared that one of the biggest insurance companies in the world was about to go under, and that would have taken several major banks with it. The federal government stepped in, and Congress passed something called the Toxic Asset Recovery Plan and basically allocated $740 billion to the banks and to the stock brokerage houses to bail them out, to make sure that the system did not implode. They were exciting times, and it was very difficult from one day to the next to know what was going to happen when you got up in the morning and went to work. Now, there are regulations on all of this. A regulation is government control on some type of market activity. There is something called the Security and Exchange Commission, which is supposed to regulate the stock markets and other security markets, and they do try. But when billions and billions of dollars were at stake, their ability to regulate was quickly overwhelmed by the greed and the grasping for power of the people who wanted to make and control all this money. The Federal Deposit Insurance Corporation is a quasi-governmental agency. It guarantees that the average depositor will not lose their money if a bank or a credit union goes under. I take it back, for credit unions, there's something called the NCUA, which is the equivalent of the FDIC. But they also are supposed to supervise the bank. So as well as giving insurance to the depositors, they are supposed to have some regulations. But during this period of time, they failed to do that, and we ended up with a situation where the national economy came very close to collapsing, and only by the expenditure of billions of dollars, hundreds of billions of tax dollars, were they able to back things back from the cliff. All right, getting back to more practical things. What happens if you buy a piece of property, you take out a loan, you give the bank a mortgage, and then you don't pay? Well, the first thing that happens is you are in default. Default means you have not fulfilled your side of the bargain. Now, the primary reason for default is non-payment of the principal and interest when it's due. However, almost all mortgages are written with some other realities, some other conditions, such as the homeowner, the property owner must pay the real estate taxes, the insurance on the property, water bill, sewer bill, keep the property in good repair. If you fail to do any of those things, you're also likewise defaulting on the mortgage. Now, once you default, several things can happen. The first thing that happens is that you end up having to pay a late fee. The vast majority of mortgages, and almost every mortgage that's regulated or controlled by the federal government, has their payment due on the first of the month. Almost all of them have a 15-day grace period built in to the language. So what that means is even though your payment is due on the first of the month, If you don't pay by the 15th, then you're considered late. Up until the 15th, you can make your payment and there's no particular penalty other than be wary. Some banks report this to the credit bureau. So if you're consistently paying on the 14th day, you may not have to pay a late fee and you may think everything's good and fine with your bank, but lo and behold, when you go to borrow money to buy a car, you might find out that they won't give you the loan because they're looking at a credit report that says you are constantly and consistently late on your mortgage. Once you pass the 15 days, the first thing that happens is that a late fee is assessed. The late fee is usually 4 or 5% of what the monthly mortgage payment was supposed to be. So if you have a $1,000 monthly mortgage payment, your late fee would be between $40 and $50 most often. Right? Once you get past 30 days, now you're in a very serious state of default. And one of the things that the bank is allowed to do under the promissory note and under the mortgage is to do something called acceleration. Now, you have taken out this mortgage when you purchased the house, and the bank has agreed to allow you to pay X number of dollars a month for 30 years. You fall behind, and you're saying, oh, I'm 3 months behind, I'm $3,600 behind. If I could just get the $3,600 and catch up, I'll be fine. Once you've gone past the 30 days, the bank does not have to play any more games with you about your being late. They can call the entire balance of the loan immediately due and payable, and that's what acceleration is. So all of a sudden you get your mother or your aunt or your cousin to loan you the money. You go up to the bank, you say, all right, here I've got the $36,000, I can catch up. And the bank turns around and says, you owe $487, $384.42 at this point in time. You owe the entire mortgage. There are processes in place now where you can contest that. You can go to HUD, you can go to the FHA, and there are agencies to assist you, to help you get back on track. But remember that, and there are regulations that control the foreclosure process and have made it a little bit more humane for the borrowers. But just beware that the technical rules are, once you've gone past 30 days, you are in serious default, and the bank can accelerate. Now, if the bank accelerates the loan, since it's all immediately due and payable 60 days from now and you do not pay, now the bank has the right to foreclose. Foreclosure is a legal process where the lender seizes the property and sells it to cover the defaulted loan. There are several types of foreclosures. This law is very different from state to state, even from Rhode Island to Massachusetts. The regulations and the rules differ tremendously. Very little federal legislation on this, except to try to regulate the banks. But when it comes down to the actual foreclosure on a house-by-house basis, state law applies, and it differs dramatically from place to place. In many states, foreclosure is a judicial process, which means the bank or the lender has to institute a court case, and the court supervise the foreclosure process and the auctioning off of the property. Rhode Island and Massachusetts are basically non-judicial foreclosure states. The bank does not need to involve the court. There's certain notices they have to give out. There's certain publications they have to do in the newspaper. Once they have done those things and they have the evidence to prove after the fact that they had done them, then they can go ahead and hold an auction and come on the property and sell it while you're standing in the window looking at them out on the front lawn, selling the property. Mortgages fall into two categories, and they're basically split down the middle of the country. In the eastern part of the country, mortgages are what we call recourse mortgages, which means that if the bank forecloses, sells your property, and you are so far in debt and so many fees, lawyers' fees and collection fees and late fees and interest have piled up, that the sale of the property does not cover the balance of the loan. In states where they are recourse mortgages, not only have you lost the property, but now the bank can go to court and sue you for whatever balance remains, whatever balance is owed that wasn't paid by the foreclosure process. In non-recourse states, which are primarily California and some of the other western states, residential mortgages, particularly first mortgages, are non-recourse mortgages, which means the only thing the lender can do is take the property. Once the homeowner has handed the property back over to the bank, they are free and clear, and the lender can no longer come after the owner on anything that is owed or due above the sale price of the property. In some states, foreclosures are redeemable, which means that if somehow you come up with the money, you find a rich relative who wants to help you, even after the foreclosure, you can go to the person who bought at the foreclosure and legally demand that they accept payment and they give you the property back once you have made payment. This occurs primarily in the upper Midwest, Minnesota, Michigan, Wisconsin. It is not the case in Rhode Island. I've had many of my clients say to me, well, we can always get the property back after it's foreclosed. No, in Rhode Island and Massachusetts, once the foreclosure is done, it is final. There is no right to redeem the property here. When the bank decides to come after you to recover funds that weren't covered by the foreclosure, they begin a case which is called seeking a deficiency judgment. Deficiency meaning that they weren't paid in full by the foreclosure process. Judgment, of course, meaning they want to finally get a court judgment or order saying that you have to pay them the rest of the money. Judgments in Rhode Island are good for 20 years, which means if they get this judgment, they can follow you around for the next 20 years to collect their money. And of course, interest runs on the judgment just as it would on the mortgage. Bankruptcy comes into play here, and this is not a course on bankruptcy, so I'm not going to go into it in detail, but certainly if a property is foreclosed, then you can go to the bankruptcy court to have any deficiency amounts wiped out to prevent the bank from chasing you, and even a deficiency judgment can be wiped out by the bankruptcy courts. And if there's a possibility of you're saving the situation, the bank does not want to cooperate with you, you can go file bankruptcy, and the minute you do that, something called an automatic stay comes into place. All creditors must stop all proceedings against you. So literally the morning the foreclosure was supposed to happen, your bankruptcy attorney could file papers in the bankruptcy court, and that would stop the foreclosure. And if you have some reasonable way of making up the money and getting back on track with the mortgage, the bankruptcy court has the power to order the bank to accept that. If it's unlikely, after they review things, that you can catch up on the mortgage or make good on this, then the bankruptcy court will, based on a motion from the bank, free the property up for foreclosure and allow the foreclosure to go through. Some of the slang that developed 10 years ago out of the whole collapse of the mortgage industry. One was the idea called a walkaway. And a walkaway is where the people just stop paying the mortgage. They decide they're so far behind, they're never going to be able to do it. They stop paying it, they save their money to get a nest egg together, and they literally drive away into the night to some place where they hope the bank cannot find them, and they leave the real estate up to the whim of the bank as to what they're going to do with it. A banker told me this term. He said that every Monday morning when he got to the branch, the first thing he had to do was go inside the mail slot and pick up the jingle mail. And I said, what is a jingle mail? And he said, those were the keys that walking away borrowers had dropped in the bank mail slot over the weekend saying, hi, these are the keys to such and such a property. I'm done. I'm giving up. Good luck. For a period of time during the midst of all this, the banks were allowing short sales. A short sale is where the bank allows the property to be sold even though the sales price will not bring in enough money to cover the entire principal balance and interest due on the mortgage. And short sales became a way for banks to process properties without having to foreclose on them. The results of a short sale could be two different things. One is that there would be a short sale where the bank would then forgive whatever extra was owed on the property and the borrower never had to pay that. Or in many circumstances, they would allow the house to be sold. The bank would take all the profits from the sale, and then if the borrower still owed $10,000 or $15,000 or $20,000, they would have to sign a personal loan agreement with the bank to continue paying on that shortage. All right. Coming down to the bottom of the fourth page of this handout. Mortgage brokers are parties who make their livings by finding borrowers and basically selling them to other institutions, to banks or lending companies. The brokers are paid a fee for setting up the loan, sometimes by the borrower, sometimes by the ultimate lender, or sometimes a little bit by both. Points, which you don't see very much anymore. This is the travails of the last 10 years have kind of wiped this out, but it was very common in the days before 2010 or 11 for banks to charge something called points. Each point represented 1% of the principal of the loan, and this was just a basic fee for the bank giving you the privilege of borrowing their money. So on top of having to pay interest on the outstanding balance once the loan was set up, in order to set up the loan, if you had a $100,000 loan with 2 points, the bank was actually taking $2,000 at the closing in fees for you just for being nice guys and having set up the loan. Again, another thing that still exists but has pretty much disappeared is something called yield spread premiums. Mortgage rates go up and down. On any given day, there are a number of different lenders offering different mortgage rate interest rates, and even within a particular lender, they may have 4 or 5 different products that are pegged at different interest rates. If a broker was able to get you to accept an interest rate that was higher than the lowest one being offered by the markets in general or by the particular institution on that day, they were basically paid a bonus, and that bonus was called a yield spread premium. So in this situation, the broker, who theoretically is working for you to help you find the best loan, is actually working for themselves to find a loan to place you in that will possibly not be the best interest rate you qualify for, but one that you accept, and because it's higher than the market rate, or the best market rate, the broker is now going to be paid a bonus. And this had to be revealed on settlement statements. It still does. However, it's such a complicated process. I've had very few clients who actually understood what was happening when I tried to explain that to them. Predatory lending was rampant before 2010. Predatory lending, it was where brokers who were trying to earn their commissions will go out and basically entice people who couldn't afford to buy these properties into buying them and taking out humongous mortgages, helping them very often along the way to forge tax returns, pay statements, credit reports, other documents that would help them show that they qualified for more money than they actually could afford to repay. The basic definition of predatory lending is a practice by mortgage brokers or lenders using sales pitches to have the customer borrow money which, number one, they don't need, number two, cannot repay, and number three, for high fees or sometimes for interest rates that are higher than market rates. Rhode Island now has a procedure whereby if somebody is refinancing, the lender actually has to give a comparison of their present mortgage as opposed to the new mortgage that they're taking out, and they have to give that to the borrower, has to sign it, and they have to show, particularly if they're taking out money at a higher interest rate, they have to show that there's a reason for doing that, such as the borrower wants to send a child to college or pay for a wedding or pay for a new car. These regulations were put in by the State of Rhode Island Banking Commission after the crisis in an attempt to try and regulate some of this. One of the things that led to the disaster was the idea of subprime mortgages. A subprime mortgage is one where the borrowers do not have good credit, but they're allowed to borrow money anyways, very often at a much higher interest rate than other people. So now you're in a double whammy. Not only are these people have shown themselves not to be reliable with credit, but you're giving them an extra expensive loan and telling them they have to pay it back. Credit bureaus, traditionally, before they used the FICO scores, did something where they called ABCD credit, so that they would basically, in the credit report, they would basically categorize you as an A, B, C, or D borrower based on your credit worthiness. Traditionally, only people with A-rated credit could borrow money. But as the housing boom went on, as more and more brokers began to get into it, as the people in New York, in London, were looking for more and more mortgages to securitize and didn't really care what their quality was, the different folks originating the mortgages moved into subprime mortgages. They began to originate mortgages where people only had B and C credit. Another term for these loans were called Alt-A paper, meaning that, I take it back. They were not. Alt-A paper is something where if you had good credit, but not the necessary documentation, such as asset verification, wage or income verification. For business people, traditionally you had to be in business for 2 years and have 2 years worth of tax returns from your business to show that you were making money on a steady basis. If you did not have that, there was a whole set of subprime loans that were given out solely based on your credit. So if you did have an A credit rating, you basically could borrow any amount of money. They didn't check your income, they didn't check your assets. We began to call these liar loans because they were based on stated income. They would ask the borrower, what's your income? The borrower could put down any money. They wouldn't ask for tax returns. They wouldn't check with the credit bureau as to what the people were making. They wouldn't ask for wage statements. And again, that was a great source of fraud and a great source of problem, as these people ended up not being able to pay these loans. As part of the banking crisis, a practice that still goes on all the time today came to have a lot of attention, and people began to realize that it was a somewhat nasty thing, but it was the reality. When you originate a loan with a particular bank or credit union or mortgage company, 90% of the time, those folks do not hold that loan for 15, 25, or 30 years. They take it and they sell it to other investors, other institutions. This is called an assignment of mortgage. And as the boom was going on, assignments of mortgages became fast and furious. I had clients whose loans were sold 3 and 4 times in the period of a year, and where they would send payments into who they thought held the mortgage, and the payments would be sent back saying, "We don't have your loan anymore, good luck." It was really a chaotic time. Things have slowed down now. It's not as chaotic as that, but the mortgages still get assigned, and very often, for most people, if you take out a 30-year mortgage to buy a house, who you're paying at the end of that mortgage is not going to be the same person you were paying in the beginning. Now, as the foreclosure crisis blew up and these loans began to go bad, several things became readily apparent. Number one, it became impossible in some situations to even know who owned the mortgage. They had been securitized and sold and resold and transferred so many times, very often without the proper paperwork, without assignments being put in the public record books at the town halls, without endorsements to the promissory note. A promissory note operates in the same way as a check. In order to cash a check, you must sign your name and put something like pay for deposit only, or pay to account such and such, or sign your name and pay to Mary Smith, and then Mary has to sign her name to deposit the check. Those are called endorsements. Promissory notes need to be endorsed in the same manner that your checks are. And as these loans were being bought and sold and tossed up and down and sideways, came to find out that many times the endorsements were not made, and when it came time to foreclose the property, or even worse than that, when somebody was trying to sell or refinance their property, it was impossible to find out who held the mortgage and who were supposed to make payment to, and who had the right to return the promissory note marked paid and to put something in the public record book saying, oh yes, the mortgage has been paid. Some of that stuff is still not clear today, 11 years later. I still occasionally run into clients when they go to sell or refinance, we have to go digging to find out what happened with their mortgage, or how the person they're making, or party they're making the payments to presently, how they came to own it over the course of time. This became such a crisis that in the height of it, the crisis part of it in 2011, 2012, there are actually a number of exposés done by different reporters and investigative journalists showing that a number of the banks had hired people to supposedly take care of this paperwork, and they were just blatantly forging it. They were creating false affidavits to go to court with to start the foreclosure processes. They were forging signatures to make it look like there had been endorsements and assignments of mortgages. And that is where the term robo-signer came in. There were some places where they literally hired people for minimum wage just to sit there and sign the name of somebody on hundreds of documents every hour, so that they could then put these documents out and pretend that they were real, they were valid. At any rate, may we never return to those days. Things have quieted down now, and the mortgage industry appears to be operating at a much calmer and saner level, albeit with far greater federal and state regulation and oversight than existed in the past. All right, some economic terms that come into play with mortgages and with the general buying and selling of property or dealing with property, either on personal property or real estate. That's just good for you to know, makes you sound intelligent, and we shouldn't let you out of here without giving you some of these terms. Inflation is a market-wide increase in the value of goods and services. So when prices generally through the economy are going up, we call that inflation. Deflation is a market-wide decrease in the value of goods and services. So what happened in the 10 years ago, or going back now 20 years ago, from 2000 to 2007, in the housing industry, we saw incredible inflation. The value of houses kept going up and up and up. Then when they reached the point where that couldn't be sustained anymore, we had a very dramatic and frightening deflation, where prices just dropped. And I mean, in Rhode Island, prices generally dropped by a third. In some of the older cities and towns, they dropped by 50% in less than a year. It was incredible how quickly the deflation hit and came in. A recession is generally defined as 2 quarters in the economy where it is shrinking and growth is negative. And they count growth by something called the gross domestic product, or the GNP, the gross national product, which is supposedly a number of all the goods and services produced during a quarter in the economy. A depression is an economic contraction that is worse than a recession. Keep your eyes open to the news now, based on what's happened with Corona-19 and the stopping of the economy for everybody to quarantine. Some people are saying we've already begun a new depression. Certainly we were already seem to be heading into a recession prior to all this upheaval. The Great Depression was a worldwide economic contraction that generally was seen to begin in 1929 when the stock market crashed, and really did not end for the United States until 1941 when we got into World War II. Some people, they didn't really seem to stick, but for a while they were calling the crisis in 2009 and 10 the Greater Recession or the Greater Depression. But we kind of got past that, and people have sort of forgotten about that. A Ponzi scheme is a scheme that pretends to be an investment scheme where the person who is running the Ponzi acts as an investment broker, takes in people's money, but instead of investing it, uses it, spends it, and keeps bringing in people money from more and more people, and uses the new money coming in to pay off older people who want to get their money out. It is a pyramid, and eventually it will collapse because it needs an unending stream of new people coming in to keep it going. If you go back and Google the idea of Mr. Madoff ran one of the most successful and most economically large Ponzi schemes in the history of the universe. It was caught a number of years ago in control of billions upon billions of dollars. A bankster. During the height of the economic crisis, a number of people became very upset with the banking system, with the bankers who had allowed this to happen or had been involved in it happening, and came up with this kind of blending of the terms between banker and gangster. Too big to fail. This idea goes back to the 1990s. And it was the idea that certain banks had become so big within the economic system that the government and the Federal Reserve Bank would do anything they had to make sure that bank did not fail. Back in the late 1980s, there was a bank called Bank New England that grew by buying up smaller banks. Prior to the 1980s, particularly in Massachusetts, banks were not allowed to have branches outside their county. They were not allowed to have branches outside the state. And the bankers, of course, moaned and groaned about that as people like Bank of America and Wells Fargo began to move across the country. So the rules were changed. And Bank New England quickly went buying up small local banks in every city and town in Massachusetts, Vermont, New Hampshire, even Rhode Island, to the point where there were times when I was getting reports that a certain bank had been bought by Bank New England, or I'd call up looking for information on one of my closings, and the people in the bank didn't even know yet they had been purchased, but we had been getting information from the title company saying, oh yes, they've been purchased. Bank New England eventually went under, and it was such a large bank by that point in time that I remember it distinctly. We had heard rumors that Bank New England was insolvent, that the federal government was going to step in and take it over, but nobody had seen that happen since the Great Depression. Nobody really knew how that would work, and it was very seamless. The federal government came in and took over, and at midnight on one night, Bank New England ceased to exist, and the new Bank of New England took its place at all the ATMs and on all your bank statements and accounts and whatever. The federal government and the Federal Reserve basically put in the money to keep the bank from exploding and to keep people calm and to make people realize their deposits and their assets were secure. QE 1, 2, 3. We've now had QE 4. It's a term. It refers to something called quantitative easing. The Federal Reserve Bank is allowed by Congress to issue our currency. And of course, currency is issued two ways. It's issued in coins and paper. So even though the Treasury prints this up, the Federal Reserve Banks are the ones who hand it out. And today, currency is created digitally. When banks make loans, they're basically creating currency. And the Federal Reserve, being the bank of banks, basically, I'm making it theoretically very simple, but by adding zeros to their computer bank, they can create new money. And during the years after 2008, when the economy was still reeling from the banking crisis, the Federal Reserve began issuing tons of money, buying up assets, and constantly injecting money into the system to keep it going, to keep it solvent and liquid. For those of you who pay any attention to economic things, there was something that happened last September where credit markets began to seize up again, where they began to be illiquid. And since then, the Federal Reserve has been dumping tons of money into the markets every couple of days. Quietly, people who pay attention to this stuff know what's going on, but the general public has really no idea. And of course, now with the coronavirus shutdown, they have just, with the help of Congress, issued another several $1 trillion into the economy. One of the fears of doing this is that we have not increased the number of goods and services that are available. As a matter of fact, for the past month, the number with the stoppage of production in China, the goods and services available have actually begun to collapse, begin to shrink, but there's more money floating around in the system. And many economists believe that that's the basis for inflation to take off, because you have more money chasing fewer goods. The people who hold money are willing to pay more to get the fewer goods, and then it becomes a self-fulfilling circle where the prices just go up and up and up. Moral hazard is the idea that we have to be very careful about forgiving debts for people, because if the general public gets the idea that, gee, we never have to pay our debts, then they will stop paying their debts if there's no negative ramifications for not paying your debt. So one of the things that this gave justification to in the last crisis was the fact that the government bailed out the banks but did not bail out the individuals who were losing their houses. And there are some economists who have plotted this and charted it and have said that with the nearly $1 trillion that were given to the bank, the federal government could have paid off every single mortgage in the country held by private individuals on their residence. And the federal government chose not to help those people, again, out of fear, being told by other economists that, oh, if you do that, you're going to create moral hazard. People will get the idea that they'll always be bailed out and they don't have to worry about paying. It appears to me that what happened is the banks now have the idea that they will always be bailed out and don't have to worry about making horrible investments. But you and I, average citizens, are still going to have to bear the brunt of not being able to pay our bills. Deleveraging is reducing your outstanding debt and trying to get out from under debt. Hypothecation is using property, a fancy English word for using property as collateral, such as a mortgage. Rehypothecation is an interesting thing where people take the same asset and they use it to secure several different loans. And of course, when everything blows up, what invariably happens is there's not enough money to pay everybody. The basic rule is first in time, first in right. So then there's a big fight on to determine, well, who was the first one to use this particular property as security. ZIRP was something that just about happened this past year. ZIRP is a slang for zero interest rate policy. The Federal Reserve Bank has been lowering interest rates since 2008, and this year got very close to the point where the banks were able to borrow money from the Federal Reserve for nearly nothing. All right. There is also the idea, and this has happened in Europe, of negative interest rates, where the bank will actually pay you to borrow money, which sounds like a totally bizarre concept, but some people have advocated this as a way to keep the system liquid, to keep money flowing, is that you actually entice people to borrow money, and then they'll take that money and put it into the economy. All right. That ends chapter or handout 11. We had done handout 12 before spring break. It was the 1.5 page on condominiums. I really don't want to say anything more on that point right now. So the next thing that I'm going to post will be the handout for handout 13, which has to do with landlord-tenant law. If you look at the calendar I gave you, the names on some of the handouts are mixed up, but just follow what's been posted in Blackboard and you will see. So the next handout that we're going to go to is handout 13.